This will be the ultimate guide in dividend investing, especially for those of you that are beginners, but even those of you that have been investing for a little while. I think you're going to learn something in this video. Dividend investing is one of my favorite ways to get passive income because it's really one of the only ways to make it actually truly passive. You may be able to make more money in real estate or in building up a business, but those are active forms of ways to invest. If it's more your style to park your money into a relatively safe investment and then just be able to get a dividend every single quarter just because you've been investing with this company and you get that money for the rest of your life, this video is going to be for you. Now in this video, we're going to discuss dividend payments, dividend yield, a couple of the important ratios, how dividends are taxed, smart dividend investing strategies, and then a couple quick examples for you to be able to figure this out on your own and be well on your way to financial freedom. And this will not be complex or complicated because I'm Professor G and I made this channel to make investing simplified. Whenever you look up a company's stock summary, one of the key numbers you'll see is dividend and dividend yield. This is saying that if you buy the stock for this price, that the dividend you'll receive each year is this. Now let's do a quick example. Say you buy 100 shares of a company for $10 each, and each share pays a dividend of 30 cents annually. If you invested $1,000 over the course of a year, you would receive $30 in dividend payment. That works out to a 3% yield. Then what you choose to do with those dividends is up to you. You could reinvest them directly back into that company to buy more shares of that company. You could use that money to buy stock in a completely different company. You could just take that money and save it, maybe in a high yield savings account. Or you could just take that money and go buy your Starbucks for the day or do whatever it is that you'd like with that money. It's yours. A quick thing to note that a lot of people don't really understand is that regardless if the company's stock goes up or down, you still get a dividend as long as they're paying out those disbursements. So anytime you go and buy a dividend stock, it's going to tell you the actual dollar amount of what the dividend is. So for example, if it's a $10 stock and they say they're going to pay out 50 cents, that's a 5% dividend yield at that time. But if the stock price goes down to like $5, that dividend amount is still the same at 50 cents. And so now the dividend yield is 10%. So when I look at dividends, I look at it more like if I own one share of this, how many dollars am I getting in dividends for owning that one share? Because then it makes me be able to forecast later, and it doesn't really matter where the stock price is at because the yield will change based off of that. And that's good for you to know right now because a lot of stock prices of a lot of companies are down because we're kind of in this down market. And so if you're going purely off of the stock yield percentage, some of them look a little more favorable than they actually are. So you're going to hear this a lot in this video, but definitely don't go off of just the high yield percentage. Go off of more sustainability, which you're going to learn more about in a second. And I'm going to give you a couple lists of stocks for you to be able to look through as foundational and solid investments for you to have in your portfolio. But more on that in a little bit. So let's talk about dividend yield and other key metrics that you need to know as a dividend investor. Because before you buy any dividend stocks, you need to be able to know how to evaluate them. These metrics can help you understand how much in dividends to expect, how reliable a dividend might be, and most importantly, how to identify red flags. First is the dividend yield, and this is the annualized dividend represented as a percentage of the stock price. For instance, if a company pays $1 in annualized dividends and the stock costs $20 per share, then the dividend yield would be 5%. Once again, make sure that you're not just looking at a terribly high yield and making your decision based off of that. You're going to want to pay attention to these next couple metrics as well. Next is the dividend payout ratio. This is the dividend as a percentage of the company's earnings. If a company earns $1 per share in net income and pays 50 cents per share dividend, then the payout ratio is 50%. In general terms, the lower the payout ratio, the more sustainable a dividend should be. And this makes sense because if they're paying out over 100% or something, then that means that they're giving out much more money than they should be, and they should in fact be using that money to pay down debt or to use as innovation to continue to grow. So you want that payout payout percentage to be under 50%. Now, the cash dividend payout ratio is another thing that I look at, and this is the dividend as a percentage of a company's operating cash flows minus capital expenditures or free cash flow. Investors can use the cash dividend payout ratio along with the simple payout ratio to better understand a dividend sustainability. The next thing that I look at, and that's very important, is to look at the total return. This is the increase in stock price, known as capital gain, plus dividends paid. For example, if you pay $10 for a stock that increases in value by $1 and pays a 50-cent dividend, then that $1.50 you've gained is equivalent to a 15% total return. The next one is earnings per share, or EPS. The EPS metric normalizes a company's earnings to the per share value. The best dividend stocks are companies that have shown the ability to regularly increase earnings per share over time and thus raise their dividend. A history of earnings growth is often evidence of durable competitive advantages. And if you've been following this channel for any period of time, I'm sure you've heard me say the words competitive advantage many times. Those are the types of stocks that I look for and the ones that I regularly invest in. The last metric that you need to understand is the PE ratio. The price to earnings ratio is calculated by dividing a company's share price by its earnings per share. The PE ratio is a metric that can be used along with dividend yield to determine if a dividend stock is fairly valued. And for me, when I'm looking at PE ratios, depending on the type of company, I definitely want to see it under 30, but I'm really happy if it's under 20. So now most people understand that if you buy a stock for $10 and it goes up to $20, when you sell that, you've made a gain of $10, so you'll be taxed on the $10 of the gain that you made on that investment. But something that regularly trips people up, at least when I'm talking with them, is how dividends are taxed. Because at the end of the day, that is a gain. That is money that you're making from your investment, and so it will need to be taxed at some point. If you have these dividend stocks within a Roth IRA, then you don't have to worry about that. It's growing tax-free and the dividends are tax-free as well. You just can't touch that money until retirement age of 59.5. But if you have these dividends in a brokerage account, then you will be taxed even if you're reinvesting the dividend right back into your investment. Most dividend stocks pay qualified dividends, which depending on your tax bracket are taxed at a rate of 0% to 20%. So at the most, if you made a dividend of $10, you'd have to pay $2 in taxes. Sometimes people freak out and don't want to have dividends just because they're going to have to pay a tax. But you have to remember that if you make $10 and you have to give back $2, you still have a gain of $8. I think that's definitely worth it, or at least not a reason to not invest in this asset class. So like I said, most company stocks are taxed in something called qualified dividends, but then there are other types of dividends that are called ordinary. And these are things in real estate like REITs and then also MLPs. I'm not going to go into that here, but just know that those REITs will look favorable because they're going to have a higher percentage yield as far as dividend, but you're going to probably have to pay higher taxes. So make sure to research exactly what type of dividends that you're going to be earning. If you're going to be doing any substantial amount of investing in dividends, it's a good idea to talk to either a tax professional or a finance professional just to make sure that what you're doing makes sense and that you're safe. Because this information here is stuff that I know from my own investing and from my research that I've done for you, but I'm not a financial advisor, so make sure you dive a little deeper into that. So on to some dividend investing strategies. The first thing that I want you to consider is if you're going to be adding dividends into your portfolio, make this a portion of your portfolio, but not your full portfolio and the only way you're investing. There are a couple reasons for this, but one of the biggest ones is that a company can cut its dividend at any point. The types of companies that I'm going to recommend and that I've been investing in aren't cutting their dividend and doesn't look like they're ever going to. They're actually growing their dividend every single year. But it is a possibility that a company could struggle for a while and then they have to cut that in order to preserve the health of the company. Another aspect of the dividend investing strategy is to make sure and figure out what you're going to do with those dividends. My personal opinion and the way that I do it is that I just reinvest it directly back into whatever it is that I'm investing in. The reason that I do that is because compound interest is your friend, and so the longer that you have something invested for a longer period of time, the more it's going to grow and the more it's going to compound on itself. But even more so, if you're able to add the dividend payments back into the fund, it's just going to grow that much faster. Some investors opt to reinvest their dividends manually, while others use a dividend reinvesting plan, also called a DRIP. This powerful tool will take every dividend you earn and reinvest it without fees or commissions back into shares of that company. Multiple studies show insane numbers of what happens when you reinvest your dividends versus not reinvesting over time. That could be the difference of hundreds of thousands of dollars. Now, along with investing into individual dividend companies, there's also a dividend investing strategy where you invest in dividend ETFs or mutual funds. And honestly, if you're an absolute beginner, that's definitely where I'd start. An ETF or even a mutual fund is just a group of company stocks. So when you buy one share of this ETF or mutual fund, you're also buying a small piece of 100 different companies, or however many companies they have within their ETF. And the most important reason to do that is to mitigate risk. If 10 of those companies in the fund just totally crash that year, but 10 or 15 of the other companies in there totally crush it, then it's going to kind of even it out, and it'll make it so that you don't lose money. So for me, when I started out, my first 5 years of investing was just 100% ETFs. A couple of super solid dividend paying ETFs that I really like are SCHD and also VYM. I made a super in-depth video on SCHD that I'll link to in my description so you can watch that later. But for those of you that are starting out, that's really where I'd start. So now the way that I like to actually look at investing in dividends is to look at how much it's going to cost me to be able to invest into these companies or into this ETF to be able to get a goal amount of passive income every single month. And so here are 3 quick examples to make it so that you can have the math a little bit simplified for you, so that any stock or any ETF that you're looking at, you can do this same math in the same formula, and you can figure out how much you're going to need to invest in order to make a certain amount for your goal. And real quick, remember that the dividend yield percentage that you're going to see is based off of an annualized return. So that's for the whole entire year. So if you're trying to figure out how much you want per month, make sure you take that number and multiply it by 12 so that you're then saying, this is how much I actually want per year. So if you wanted $1,000 per month, that's actually going to be $12,000 per year. You basically just divide the amount of money you want to earn in dividends per year by the dividend yield percentage. So for example, Coca-Cola has a 2.87% dividend yield. So you'd take $12,000, divide it by 0.0287 or 2.87%, and that comes out to $418,118. So that's basically saying that you're going to need to invest that $400,000 in order to make $1,000 per month in passive income. And this is usually where I get a bunch of haters down in the comment section that say, oh yeah, let me just find $400,000, so easy. No, it's not easy, but it does compound over time, and so you don't have to find $400,000 today. Just buying share by share every week or every month really adds up quickly. Now with Coca-Cola's share price of $61.43, you'd need to buy about 6,806 shares of Coca-Cola to reach that goal. Now when a company does have a higher dividend percentage yield, that means that you're going to need less money in order to reach your goal. So taking a company like Altria with an 8.24% dividend yield, when you divide $12,000 by 0.0824, that equals $145,631. So that's almost 4 times less money that you'd need to invest into that company in order to make that passive income goal. But be careful, because companies that have such a high dividend yield usually don't sustain that dividend yield long term. So definitely do your research into what type of company you're investing into and how long they've had a dividend that's anywhere near that number. Now looking at the ETF I was talking about before, SCHD, with a dividend yield of 3.29%, if you take that $12,000, divide it by 0.0329, that equals $364,741 that you'd need in order to get that $1,000 per month of passive income. Now yes, these numbers are high, but again, we're talking about truly passive income, other than you having to put the money in and not using that money to go buy new clothes or something, there's not really much work that you have to do after that, and you'll get a payment residually forever as long as you're picking the correct types of stocks or ETFs that can sustain their dividend. And so now, as far as which ones that you're going to want to invest in, I'd definitely start with that ETF of SCHD, but simultaneously I would 100% recommend that you are doing your research on the dividend stocks and companies that you'd like to purchase in the next year or two. The companies that you need to look at are on a list called the Dividend Aristocrats or the Dividend Kings. These are companies that not only have just had a dividend consecutively for over 25 years, but they've actually raised their dividend every single year for a crazy amount of time. Some of them near 70 years of consistently adding to their dividend every single time. So if you would have bought the stock 70 years ago, not only would you get the appreciation in how much the stock is worth, but also that dividend has grown so much that whatever amount of money you put in then is worth an amazing amount now. And lucky for you, I did all the work for you and compiled this top 10 list of dividend stocks that I think that every investor should include in their portfolio, whether you're a beginner or you've been doing this for 30 years. So do yourself a favor and watch that video now. And when you do, let me know which one is your favorite.